Good morning, good afternoon, good evening, depending where you are in the world today. I am Enrico Camirinelli, Strategic Advisor at the IT Novarica Group. And today we're going to speak about sustainable supply chain finance. I have with me an esteemed group of panelists, starting from my right with Adair, Executive Manager of Business Banking Area at NTT Data, followed by Roshni, Head of Risk Practice at Quantexa, and then we have Marina, Global Head of Advisory at GTB BBVA. You can see that the agenda for today is pretty full, and I will start with a quick presentation of general trends in the market, speaking about sustainable supply chain finance. I'll be followed by Adair, that will speak about how the whole initiative ESG, why does it matter from her perspective as a global consultant. Roshni will introduce us the importance of managing data, and then followed by a practical example, a testimonial from Marina. So without any further ado, before starting my presentation, I will let each of my esteemed guests to make a quick intro of themselves and why is ESG important for them. So Ada.
Hi, I'm Adair Astigarraga. I'm Executive Manager in the business banking area of NTT Data consulting firm. And I belong to the global corporate banking practice where we provide services to our clients, banks, related to how they can approach business transformation and how they can make their business grow. So today I'm going to be focusing on ESG in supply chain finance area and how we are helping out these clients, the banks, transitioning into ESG initiatives in their supply chain finance area.
Okay, Roshni, tell us a little bit more about yourself.
Thank you, Enrico, and thank you for having me here as well. My name's Roshni Patel. I am the head of risk practice, like Enrico said, and what we really are seeing in the market is ESG is front and center of every people, every person, every institution globally. And one of the things that I want to talk about today with Enrico and then the rest of the panelists here with Ida and Marina is how to get the best out of what is available in the marketplace today. From a data perspective, from how does that connect with technologies and the challenges we have. So how do you take what is front of center of mind for everybody and make that best for organizations? So I look forward to the conversation today.
Thank you. Marina.
Hi, Marina Andres. I'm the Global Head of Advisory GTB in BBVA. So within my role, I'm responsible for sustainability in the global transaction banking products. And why ESG is important? I think it's a big opportunity for banking and specifically on supply chain finance, as our clients, the corporates, they see the impact that ESG is having on their everyday business, and it's already going into the financing and how they approach the financing regarding ESG. So we are going to talk about it later. So thank you very much.
Yes, this was just a quick intro. My role here is to basically set the scene and share with you the findings of my research in the space. So I'm going to touch on 3 topics that actually are part of the typical questions that we get asked from our clients and also in the conversations we are having around ESG. So first of all is what are corporations asking of ESG? Because at the end of the day, banks sell to corporate clients, at least we are in the space of corporate banking. And so it's always important to understand what is in it for the end user. And then the second is, okay, if this is what corporations are looking for, how are financial institutions supporting their corporate clients in their ESG strategy? And last, why does this matter? So how are organizations measuring their ESG success, if there is any success? So this is also what we are going to discuss today. So for the first part, what are corporations asking of ESG? These are busy slides, but you will have the time to read them again, of course. What is important is to touch upon, maybe looking at the left side of this chart, is asking to corporate users what are the hot topics on ESG, if we just focus on the first three most, let's say, answered questions or most voted options. What data do banks use to set up ESG? Why would ESG be important in Treasury, and how do you measure your compliance to ESG offers? I would say that the so what of the findings of this chart, you can read them at the bottom. So first of all, corporations want to know what new options are available to them, because ESG is rather new in the corporate world. And so if there are solutions out there, is there anything new beyond what is normally being offered by banks to corporations? Or if it's, let's say, traditional solutions, what makes them different, being them ESG tagged? And then what we learn more and more, and I guess this is going to be also the core of today's conversation, is that corporations are looking for advice. So before making a decision, can anybody help me understand what others are doing? Why should I do it? And what are the options available? On the right-hand side, there are statistics coming from a flagship study that IT and America Groups runs every year. And we have around 180 respondents coming from mid-sized to large organizations from North America and major European countries. And basically the question was, if a financial institution would offer you, ESG sort of based solutions, would you care about it? In essence, I'm sort of shortening the long question. And you can see that there's a level of very interested, but also, and there are some geographical differences that we will touch upon later in the conversation. But most importantly, I think from an analyst perspective, there's a good dose of respondents that are not so interested or little interested. And so the explanation of this could be either because they're still missing that part of the advisory support that they're looking for to make a better decision. And still there is a big focus just on the E, on the environmental side, while corporations are also responsible and accountable for the social part of the sustainability and also how to set up governance. So maybe the lack of interest or sort of the not so warm interest could be also because they don't just want to focus on the E part. And also the fact that data is important, and again, this is going to be one of the other topics that we'll be uncovering today, but data requires having digital solutions. And to do that, in order to make it easy to use, corporate users want to make sure that anything that has relationship with ESG transition is embedded, if you will, within their enterprise data. So how to make transactional banking also a source of data to manage the ESG part of the business. In terms of how FIs, so financial institutions, support their corporate ESG strategy, this is an oversimplified slide, if you will, but there are normally four actors. You have the anchor buyer, its supplier, then you have the financial partner and the auditor. So in the typical schemes that we see is that the anchor buyer and the suppliers have what we call an ESG protocol. So the anchor buyer typically is a big brand responsible to the eyes of their clients of being sustainable. So the big brand also has the responsibility of ensuring that its entire supply chain is as sustainable following. We don't have a unique sustainability standard. And so many times the large anchor buyer that basically sets up a program asking its suppliers to follow it. Now, the easy way to make this happen is you supplier do it, or otherwise you lose your business. But this is not really a sustainable relationship. So this has to be done in a sustainable way. So once the rules are applied, typically there is an auditor, so a third party independent, that makes sure that the supplier in this case is compliant, is following the rules, is implementing what the anchor buyer is expecting to happen. And then if so, the financial partner provides, I like to call them financial assets, because it's not necessarily only, let's say, financial instruments. It could also be financial support. And so the way that we see this happening is that sustainable supply chain finance is a way to incentivize, to encourage the participants of the supply chain to really have full adherence and compliance and ensure that the rules set in the protocol are followed. So we are moving, basically, I'd like to say, from the concept of supply chain finance as a set of instruments to improve the working capital, which is still there, but with the ESG component is also a way to improve the quality, the resilience, and the relationship in the supply chain between the anchor buyer and its supply partners. And so there are different instruments that are being used, namely the sustainability-linked loans or sustainability-linked bonds. In essence, you can read from the descriptions, is that the incentive is given basically by improved or special interest rates if you are are compliant, so if the auditor realizes that you are following those rules. If not, then you are penalized. And there are already good, say, numbers of documents out there. Namely, I listed here a few that I found in my research that are also setting some special guidelines and recommendations. So corporations and banks are not left alone. Maybe the problem is that there's an overabundance of data, of information. And so our role is also here to help weave in all this, let's say, jungle of documents, making sure that we address the right ones, and especially from the real life words of participants to today's panel, being able really to understand what really matters. It's important to say that the attention of ESG and ESG-linked products and services has escalated up to the European Commission. So there is a document already dated 2020. So let's say that it's pretty mature, where there is, I just made an extract of this long document that basically puts at the same level, if you see the chart on the right, along the three components of ESG, along environmental, social, and governance. You see in the last three columns how the different say products or financial assets, being them the traditional ones, so the ones that are in the solid line boxes, or instead the ESG linked, the ones that are in the dotted line boxes, you see that there is the attempt and the contribution of the Commission to really put together and make comparable traditional, say, non-ESG linked assets to the ESG linked assets. In terms of how to measure success, there are many ways to do it, and in today's panel we will see different suggestions on how to do it. I just want to bring up the say indicators that are say table stakes in order to start engaging and establishing your ESG strategy and then measuring the success of it. One is the Global Sustainability Standard Board reports, so the GRI standards, that are basically a set of indicators that help to measure the level of sustainability compliance of an organization. One also very important set of standards are the SASB standards that the Sustainability Accounting Standard Board, sorry, but it's a long acronym, so I have to read it. But what is important is here is what the SASB indicators measure are not only the level of, say, compliance of the company to ESG principles, but also the effect or the impact that this has to the partners, to those who work around the organization. So it's not just measuring the inside of the organization, but also if you are not compliant, if your KPIs are not as expected, what does this mean to those that are working with you as an organization? And so just to conclude my hopefully short part of the presentation, just to give an overall perspective, if we are to set the so what of this presentation along the three topics that I briefly introduced, what are corporations asking of ESG? Well, they're asking for advisory and new products. The so what for how are financial institutions supporting their corporate clients' ESG strategy is you're providing incentives tied to ESG performance. So it's important to establish the rules of engagement, the data to be collected, and establishing the important correlation between achieving a result and what is the financial impact, but also what are the expected results that you can have as a financial institution and, more importantly, as a corporation. And last, how our organization, either being banks or corporations, how they're measuring their ESG success, is using as much as possible industry standards, or at least making sure that proprietary standards are reflecting, are inspired as much as they can to industry standards. Not because we are expecting that there will be a one standard for all, but because at least that one standard will be a sort of like how can we say, like a Rosetta Stone, so that whatever metrics you're using internally, proprietary, you can always refer them back to some general principles, so to make them comparable, especially for those the companies that want to work with you as a bank. So if they're to make comparisons, they want to know, they want to measure apples with apples and not the opposite. So I finished my part of the introduction to show the overall scenario. And now I'll pass it over to Adair to deep dive into what, from her perspective, she sees happening in the market from corporate and banking perspective, and the role that NTT is playing into this. Adair?
Thank you, Enrico. So yeah, today I would like to give you an overview on how, from consulting perspective, we see that our clients, which are financial institutions, are transitioning towards ESG initiatives, especially in the supply chain finance area. But before focusing into that, I would like to give you like a brief context on this initiative, and especially focus on those main benefits that companies might have. So, historically speaking, we know that banks have had always a two-way vision in the supply chain finance, for supply chain finance businesses, by not only financing their corporate clients, but also taking the opportunity to finance the wider ecosystem, such as the suppliers. With the ESG initiatives, we see even greater opportunities here, because not only they can finance those corporate clients with high ESG ratings by granting them longer payment terms on their invoices, but also financing their suppliers for those ones that are green labeled in their invoices, and therefore discounting or anticipated funding on those invoices. So all this creates an opportunity for banks to increase their market share, because they have higher volumes in their supply chain finance programs.
Let me ask you a question, because this is important. So if these are the expected benefits, what is the strategy that banks should approach, and how do you help them?
How we usually approach banks in order to look into new revenue streams in supply chain finance, they usually leverage on certain strategies. So which ones are those ones? On one side we have sales accelerations. They need to focus on sales accelerations. They need to develop new products, new structured products, in order to get more profitability under their supply chain finance programs. They also need to define risk distribution strategies in order to reduce the capital consumption. And they are also implementing new models, like providing banking as a service solutions that are highly demanded by their corporate clients. So we see that ESG component is going to empower each of these strategies, so it's going to reinforce each of them. How is this going to happen? On the sales acceleration part, the banks have the opportunity to analyze all the ESG impacts that is originated on the client side, on the corporate client side, and on the supplier side, and this will allow them to increase their market share by offering better conditions to their suppliers and by accessing those suppliers that have been green labeled. On the new product side, banks have the opportunity here to analyze the entire carbon footprint on the supply chain activity, and therefore they can develop new structured products to position them in those corporate clients that are more in accordance to ESG criteria. On the risk distribution side, banks can here process all the data related to ESG, and therefore they can structure better those portfolios in order to sell the assets in the secondary market, and those ones that are green labeled will be more willing for potential institutional investors to buy them, to purchase them. Those institutional investors might be banks, financial institutions, insurance companies, and so on. And finally, ESG is also going to have is going to reinforce banking as a service solutions that banks can provide to their corporate clients. How? For example, providing ESG reporting, where they can benchmark industry-wise with a number or a range of KPIs, a whole comparison on ESG rating for the corporate clients. Yeah? But we also see, besides the strategies, we also see technological solutions that are key accelerators or is an enabler in order for banks to transform the supply chain finance business and in order to look into those revenue streams. So let me deep dive now into ESG. So how ESG is going to be a key driver, yeah, for that business growth in supply chain finance. So they can focus mainly on 5 different components. One of them is by customizing products, so they can develop tailor-made products for those clients according to the ESG performance of their corporate clients. Purchase order financing products is here one of them. So banks are able here to analyze the reduction on the pollution on the supply chain activity. And for those purchase orders that are more ecological somehow, they will be able to provide funding over on a purchase order instead of on an invoice. Yeah? Also, ESG has an impact on the risk models that banks are using to evaluate their corporate clients. So they need to take into account potential negative impacts or potential sanctions that the corporate clients might have in order to adjust it in the algorithms of their risk models. So not only taking into account credit risk and operational risk like historically they used to do it, but also ESG risk is going to be a big component in here. And also ESG is going to have an impact on the pricing models. So adjusting these models and setting up standard rules in the pricing rules is going to be a key aspect here for them in order to be able to segment, to do a segmentation pricing wise on those green labeled suppliers and clients that are able to discount their invoices at a better rate and sometimes not even charging them even commissions. Also, ESG will have an impact on investments. Yeah, dynamic discounting programs are here key for corporate clients that have excess cash that might want to finance or fund their own supply chain activity to their suppliers. So they will be more willing to invest in those suppliers that are more ecological and therefore to anticipate their invoices.
Technology in all this, what is it?
Technology solutions are going to be key accelerators, as I mentioned earlier on. There are certain solutions in the market, and Rosny is going to give us an overview about Quantex a little bit later on, that certain solutions that they gather all the different information, sustainable information from market data, and by identifying all this data and integrating the data and setting up a specific taxonomy of that data into specialized databases will allow them to make comparisons, as you were saying earlier on, apples with apples between those clients in order to provide them with an ESG rating. So these data, sustainable data solutions, by integrating them or connecting them to those supply chain finance platforms that the banks might have, like for example, Demica, Kiriba, C2FO, Prime Revenue, whichever platform each of the banks might have, is going to make those supply chain finance programs to be run in a much more successful way, yeah, because they will have all the sustainable data fully integrated, and therefore they will be able to not only to provide better discounting rates to their suppliers, but also all the ESG reporting that they might have to do for their management purposes.
So can you give us a quick, say, overview, because we'll have Roshni will deep dive more into the role of Quantex, but what is the kind of relationship you have with them and what is the help they are providing you with?
Well, we currently have Entity Data has a partnership with Quantexa because we want to leverage into these type of solutions in order to provide this type of services to the banks, in order to have a better understanding of the sustainable data, in order to have insightful information and to allow them to run their supply chain finance programs in a more successful way.
Okay, so I think, Roshi, now it's your time. You've been called many times to tell us a bit more the importance of data and what is the role that you play in this interesting scenario.
Thank you very much, Ida. Just to touch on something Ida said before I start is, one of the common questions we get asked is, we have all of this information and we have these clients that we want to go away and give loans to and then lend to, but we really do not know the indirect and the direct relationships that the suppliers, their suppliers, the people, the organization have. And so, a lot of, to the point that you asked, Ida, how does Entity and Quantexa work together, is really using the foundations of technology to be able to provide institutions with that context. And building on top of that direct and indirect relationships can be your pricing models. It can be your models and those decisions that you make. So it very much goes hand in hand in a good marriage. It's a good partnership. But if I talk a little bit about the trends that are currently happening in this space, and I'll talk about both ESG and then sustainable supply chain finance as well, is the trends are from a people perspective, from a financial institution, so from a banking perspective, and from a geographic perspective. So if I look at the trends from a people perspective, and Marina, you will comment on this later on, I'm sure, is everybody is looking to have a chief sustainability officer. If you want to be able to drive decisions from the top, there has to be some sort of consolidation of what is your sustainability strategy before you get into your pricing, your risk, your data, your technology. So really much seeing it as a global trend, irrespective of geographic region, where everybody's trying to consolidate and have a sustainability officer and a mandate that drives the rest of the organization from that. From a financials perspective and financial institutions perspective, the trend is there. I said that in my opening remark. It is front and center, a top 5 point in any shareholder report, any annual report you go read, and any priority into 2024, 2025. It is to help organizers become more sustainable. It is to have an ESG mandate and really drive towards that net zero 2050 emissions target that institutions have. So really that's a trend. But the trend from a geographic region, it varies. The challenge, and before I get into challenges, it's really understanding how do I look at the environmental aspects, which is regulated. There's stress tests that European Banking Authority do on climate risk. There's the UK regulator, the US and the Singaporean regulators that are asking them to do the climate risk stress test. That is regulated, that's mature, that's already there. But how do you look at the social and the governance aspects of the E, the S, and the G, and how do you link those three?
So if these are the general trends, and you already alluded to the challenges, can you tell us, what are the challenges you're seeing and how you help your clients, overcome them? And are any, you already alluded to this, any geographical differences that you see from your perspective?
Yeah, so I'll start with the geographical differences first. And Marina, I'm happy to be challenged on this when you talk about BVA. But when I look at the geographical spread, if I look at the Americas, if I look at America and specifically in North America, they don't buy in, if I can say, into the concept of ESG. They're not as adaptive to what is required to become sustainable. You've got the Fed and the market in America is talking about, ESG is subjective and ESG isn't the right way to go away and decide who to lend to. So you've got the Americas, you've got Europe and UK, who I would say is most advanced and actually the most proactive in making things happen. And they have created innovation hubs and they've created teams to really specifically look at this. The challenge for Asia, and I was in Asia last week, and one of the first two things that came up in terms of Asia was, well, for us it's less on the environmental side, it's really more on the social and governance side. Because if you look at a lot of the manufacturing that is being done, a lot of the work that goes into making Apple iPhones and any other manufacturing goods, a lot of the concentration is in Asia. So from a social and governance perspective, there isn't enough data. There isn't enough data from the manufacturers. There isn't enough data from their suppliers. And there's no consolidation of consistency of what they can use to help measure where they want to invest and where they do not want to invest, and who they want to lend to, who they don't want to lend to. So the Asia demographic is very different in terms of where they're focused and against UK and Americas, I would say.
Mm-hmm. I was just thinking that perhaps these geographical differences and also maybe could underpin the challenges, meaning that it seems that in North America there's not a real belief that is really matters, while in Asia maybe they do believe that is going to change their lives, and just wait maybe for sort of harmonization. If this is a scenario, the challenges and the geographical differences, how do you see banks and corporations approaching all this?
Yeah, a good question, Enrico. And I think, corporations, I read a statistic a while back that an average manufacturer has about 5,000 suppliers. And you're never going to get data on 5,000, on average 5,000 suppliers. So if I'm a bank and I want to lend to a corporation that has 5,000 suppliers, or I'm a corporation that needs to decide between lending to this company or this company, you need to have a huge amounts of data or some benchmarks that you can use to go away and decide which supplier as a corporation that you want to go to. The challenge for banks is, and I'll be keen to get your thoughts on this, Marina, is on average what I've seen globally, financial institutions and banks are procuring up to 30 different ESG data sources. And the challenge for the banks is, how do you create the insights, the connectivity and the context from that data together? So that's the challenge I see from the banks, is there's huge amounts of data that they can get, but how to connect it. From a corporation's perspective, is their suppliers, there's no fixed template of all of the reports, all of the questions that they need to ask. And when they do ask the questions, the suppliers may not know the answer, or they guess the answers. So the quality of the information that the corporations are going to get to decide if that's the right supplier for them is going to be subjective.
Are you seeing the same? In my part of the presentation, I was mentioning that sustainability-linked supply chain finance is used to incentivize, say, a good behavior of suppliers. But from your perspective, do big anchor buyers really care about their supply chain and making sure that it's ESG consistent throughout? Do you have examples you can give us?
Yeah, I would say, and then this is a good segue to, I read a quote recently from a Treasury and Finance Director from a company called Decathlon, which is a large sporting goods manufacturer, that 75% of their CO2 emissions comes from the production of their goods. So you've really got to think about, how do you make the production of those goods more sustainable? And to your question, Enrico, it is the larger suppliers in the market, the larger corporations like Walmart, Puma that have gone on record, Decathlon that's gone on record, they have to care about their suppliers and the network of the suppliers, because that links into Ida's point around reputational risk. And one of the biggest fundamental things that can depreciate a company's share price is reputation, is the links to any sanctioned people or organizations. So really from a reputation, from an outset perspective, they do have to care. And that is the journey that everybody's going in. Gone are those days where you had institutions that were linked to child labor or forced labor for different manufacturers. They have to care about that supply and that whole supply network that they have.
Yeah, because looking at this quote, basically the focus is still on the CO2 emissions, so still on the E part. And given that banks and corporations are pretty, say, structured and complex organizations, how do you see them getting organized to also slice and dice the S and G part of the ESG? Do they do it as a one block? Do they have different segments, sectors working on that?
Yeah, and I would say it goes to this point really well, Enrico, and I've just skipped a couple of slides, but when you think about the data is very specific and different for E, S, and the G. And that's why they're having to really get lots of different data sets together. So if you think about the data, you've got market data, you're going to get Bloomberg, you're going to get your Refinitives of the universe that are going to provide you with ESG ratings, that are going to provide you with the market data. To your point around sustainability bonds, sustainability loans, you can go to Bloomberg and start getting the information on that market-facing information. So that helps with the E. But when you then look at the S and the G, there are very specific ESG data providers out there. So you do have the Arabesques of the world, you do have Sustainalytics of the world, where they have their own methodology, they have their own way of procuring the data, and they have their own platform to consolidate that data. And then you've got what I call specialized data. You've got institutions like CDP that are great at giving you fossil fuel information, but you're also going to have specialized data in terms of news. You really need to bring in that news element for the G part, the governance part, and the social part that can talk about human trafficking or talk about management of the board, that can talk about the diversity of a board. All of that comes from annual reports and collation of those annual reports. The more you report, the more information, the specialized